Hello and welcome, aspiring investors. Today, we dive into the fascinating world of company shares. Imagine owning a piece of your favorite company and being a part of its growth story. Sounds exciting, doesn't it? That's exactly what buying shares offers. As we venture into this realm, we'll uncover the importance of shares in the investing world and why understanding them is crucial to making informed investment decisions. Whether you're a novice or a seasoned investor, understanding shares is key to making informed investment decisions. What exactly is a share? In simple terms, a share or stock is a unit of ownership in a company. Imagine a company as a pie. Each slice of this pie is a share. So, when you buy a share, you're essentially buying a slice of this company pie. The more slices or shares you own, the bigger your piece of the pie. Or in other words, the greater your stake in the company. This concept of ownership isn't just theoretical, it translates into real-world benefits. As a shareholder, you have a claim on the company's assets and earnings. You also get to have a say in the company's major decisions through voting rights. But it's not all rosy. Ownership also means you share in the company's losses. If the company doesn't do well, the value of your shares might go down. So, when you buy a share, you're purchasing a piece of a company's future success or failure. Shares come in different types, mainly common and preferred shares. Let's dive into what these mean. Common shares are the most typical form of stock that investors buy. Owning common shares generally gives you the right to vote at shareholders' meetings. You might get one vote per share to elect the board members who oversee the major decisions made by management. On the flip side, preferred shares are a bit different. Preferred shareholders have a higher claim on dividends than common shareholders. This means if a company decides to distribute dividends, preferred shareholders are paid before common shareholders. However, preferred shareholders usually don't have voting rights. Now, you might wonder why someone would choose one over the other. Well, it depends on what you value more, the potential for growth and the power to influence a company, or the stability of regular income. Understanding these differences is crucial when choosing which shares to invest in. Ever wondered how companies issue shares? It all begins with an initial public offering, or IPO. An IPO is like a company's grand debut on the stock market stage. It's a process where a private company transforms into a public one, allowing the general public to buy its shares for the very first time. But why would a company decide to take this leap? Well, going public can be a game changer. It can open up a world of opportunities for a company to raise funds, increase its visibility, and facilitate future capital raising. Imagine you're an entrepreneur. You've bootstrapped your business. It's growing, but you need more capital to expand. An IPO could be your ticket to raising that much needed capital. But it's not just a money-making event. It's a strategic decision, and it comes with its own set of challenges and responsibilities. An IPO is a significant step for a company, potentially leading to substantial growth. Shares are bought and sold on platforms called stock exchanges. These are bustling marketplaces where companies list their shares and investors come to buy or sell them. In essence, they are like supermarkets for stocks. There are numerous stock exchanges around the world, but a few stand out due to their sheer size and influence. For example, the New York Stock Exchange, known as the NYSE, and the Nasdaq are two major exchanges based in the United States. On these exchanges, shares are traded throughout the day, with prices fluctuating based on supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, when more shares are for sale than there are buyers, the price goes down. These exchanges are not just about buying and selling. They also provide crucial information about the performance of listed companies, influencing decisions of investors worldwide. These exchanges are where the action happens, with shares continuously being bought and sold. Reading a stock quote can seem like deciphering a secret code. Let's break it down. Imagine standing in front of a digital billboard flashing cryptic symbols and numbers. That's what a stock quote looks like. But fear not, it's simpler than it seems. First, the stock symbol, a unique series of letters representing a company. Think of it as the company's nickname on the stock market. Next, the price, which is the cost of one share of the company's stock. This number fluctuates throughout the trading day based on supply and demand. Then, there's the volume, telling you how many shares of that stock were traded during a particular period. Other key information includes the day's highest and lowest prices and the change, indicating how much the price has increased or decreased compared to the previous trading day. Understanding these elements is crucial for making informed investment decisions. A stock quote provides a snapshot of a company's current market performance. Owning shares comes with potential rewards, but also risks. Let's delve into this a bit more. One of the primary rewards of owning shares is the potential for capital gains. This is when the share price increases over time and you sell your shares for more than what you initially paid. Simply put, buy low, sell high. Another reward is dividends, which are a portion of a company's profit distributed to shareholders. Not all companies offer dividends, but for those that do, it can be a nice source of regular income. Now, let's not gloss over the risks. The value of shares can fluctuate, sometimes quite dramatically, due to a number of factors. This means you could potentially lose a part or even all of your initial investment if the company doesn't perform well. It's vital to remember that the stock market is not a guaranteed money-making machine. It requires careful planning, research, and a certain level of risk acceptance. Owning shares is not without risk, but the potential rewards can be substantial. Numerous factors can influence a company's stock price. Let's delve into some of these factors. Firstly, market trends play a significant role. The overall direction of the stock market can sway individual stock prices. If the market is bullish, prices generally rise, while in a bearish market, prices might drop. Secondly, a company's performance heavily impacts its stock price. Strong earnings reports, innovative products, or even a dynamic new CEO can boost a stock's value. Conversely, disappointing earnings, controversies, or poor management can cause a stock's price to fall. Lastly, economic indicators such as inflation rates, unemployment figures, and gross domestic product (GDP) growth can all affect stock prices. A robust economy often bodes well for stocks, while economic downturns can depress stock prices. Understanding these factors doesn't guarantee you'll always make successful trades. However, being aware of these influences can help you assess risk, inform your decisions, and hopefully give you an edge in the market. Being aware of these factors can help you make more informed investment decisions. Ready to dive into the stock market? Let's discuss how to buy and sell shares. The first step is to choose a platform or brokerage account. This could be an online platform, a mobile app, or a traditional broker. Each has its own set of features, fees, and user experiences, so it's important to research and choose one that fits your needs. Once you've set up an account, you'll need to fund it. This could involve transferring money from your bank account or setting up a direct deposit. Now you're ready to buy shares. Simply search for the company you're interested in, select the number of shares you want to buy, and confirm the purchase. Selling shares follows a similar process. Navigate to your portfolio, choose the shares you want to sell, and confirm the sale. Remember, timing is key in the stock market, and it's essential to have a clear strategy. Buying and selling shares can seem daunting, but with a bit of knowledge, it becomes much more manageable. One key to successful investing is portfolio diversification. It's a fundamental strategy that involves spreading investments across various assets to balance the risk and reward. Think of it as not putting all your eggs in one basket. So, how does this work in the world of stocks? Well, instead of investing all your money in one company's shares, you invest in a variety of companies. These companies can be in different sectors, industries, or even different countries. Why is this important? Each sector or industry can respond differently to market changes. If one sector is down, another might be up. By diversifying, you're not reliant on the performance of a single company or sector. It's like a safety net. If one company's shares plummet, it won't wipe out your entire investment. On the other hand, if a company's shares soar, it could boost your overall portfolio's performance. Remember, diversification doesn't guarantee profits or protect against all losses, but it can help smooth out the bumps on your investment journey. A diversified portfolio can help protect against market volatility and reduce risk. Investing is not a one-size-fits-all strategy. There's long-term and short-term investing. Let's unpack these terms. Long-term investing is like a marathon. It's about endurance, patience, and the big picture. It involves holding onto your investments for several years, sometimes even decades. The goal? To gradually build wealth over time, taking advantage of compounding returns and market cycles. On the other hand, short-term investing is more of a sprint. It's about agility and quick decisions. These investors hold on to their investments for a shorter duration, sometimes only a few months or even days, hoping to make quick gains from market fluctuations. Now, neither approach is inherently better than the other. It all depends on your financial goals, risk tolerance, and investment knowledge. Someone saving for retirement might lean towards long-term investing, while someone looking for quick returns might opt for short-term strategies. The key takeaway: whether you're a long-term or short-term investor, aligning your investments with your financial goals is crucial. We've covered a lot of ground today on our journey into understanding company shares. We've explored what shares represent in a company, the different types, and how they're issued. We've navigated through stock exchanges, stock quotes, and the risks and rewards of ownership. We've delved into the factors influencing stock prices and the process of buying and selling shares. Lastly, we highlighted the importance of diversifying your portfolio and aligning your investments with your financial goals. Thank you for joining us today, and remember, knowledge is the best investment you can make. Don't forget to subscribe for more educational content, and feel free to drop any questions or comments below. Until next time, happy investing!